In this section, let us understand the fundamentals of valuation. Firstly, what is valuation? Valuation refers to ascertaining the monetary worth of an asset. In the context of equity or business valuation, we have various references to value. One of them is book value. This is simply the value of an asset or a liability as reflected in the balance sheet of a company. Then we talk about market value, which is the value of the asset as reflected in its market price. This is the price at which you can buy or sell the asset. The third we have is fair value. Fair value is a theoretical concept. It is essentially the value at which two parties who have full knowledge of an asset would be willing to exchange it in a free market condition. That is when they do not have any coercion or force and they know about the asset, what is the price at which they would be willing to buy or sell. That's what we refer as fair value. Now let's understand each one of them in detail. First, let's understand book value. Book value, as we mentioned earlier, is the value of a financial security, asset or a liability that is directly derived from the balance sheet of a company. When we talk about current value, that data has to come from the latest reported balance sheet. We know one thing, that balance sheets are not published every single day. So we have to rely on the latest published balance sheet numbers to derive the book value. But we would know one thing, that book value of an asset is not the true reflection of its fair value. Book values are calculated based on historical cost, and balance sheet also does not consider any assets that are self-generated, which means balance sheet value of an asset is not a very reliable metric when it comes to getting the true value of an asset. And we know that equity is equal to asset minus liability. Since asset values are not reliable, the equity value which is derived from the asset value are also not very reliable. But here is one thing. When it comes to accounting principles, they are likely to err on the side of conservatism. Therefore, while book value is not really a reliable value, they are more likely to be a conservative estimate of the equity value. Therefore, many analysts prefer to look at it as the floor value of an equity. By floor value, I am referring to a pessimistic valuation of the equity. Now let us understand how the book value is computed. When it comes to book value, we can take the data directly from the balance sheet. But it's essentially going to include the following components: paid up common equity, share premium, retained earnings, any other comprehensive income or other reserves, provision for dividends. We add all this. From this, we reduce the treasury shares to arrive at book value of common equity. The first four items are fairly straightforward. Let me focus on provision for dividends and treasury shares. In certain jurisdictions, dividends for a year are provided for in the same year. By provided, I am talking about set aside. Company computes what is the amount of dividend they may pay their shareholders and creates a provision, and this amount may be shown under the head of other current liabilities. But keep in mind, this money belongs to the shareholders of the company. So when we are calculating book value of shares, we need to consider provision for dividend. So it is better we scan through the other current liabilities section of a company's financial statement to know if there are any provisions for dividends that is sitting there. Treasury shares refers to the company's own equity shares which has been bought back by itself. When a company buys shares and does not cancel it, it is shown as a treasury share. We need to reduce this to arrive at book value of common equity. But when it comes to valuation, we preferably look to a valuation based on diluted equity, because there could be certain instruments such as convertible debt or convertible preferred shares which are likely to be converted into equity shares. So if we think that there are going to be any such debt or preferred shares that are dilutive, in the sense where we expect the holders of that instrument to convert them into equity, we should also add that to get book value of total equity. But here are a few pointers to keep in mind. While calculating book value of equity, we should not consider a few things. What are they? Preferred shares that are not diluted. So there could be redeemable preferred shares or cumulative preferred shares which are not redeemable, which we are not going to consider as equity, which are not going to get converted into equity. We should ignore them. And minority interest or non-controlling interest In the context of valuation of shares, we would like to ignore them too, because we are valuing the shares of the parent company and minority interest does not represent it. So we have to exclude that. And any unclaimed dividend. Now this is different from provision for dividend. Provision for dividend belongs to all shareholders. Unclaimed dividend is essentially the dividend which we pay to some shareholders, but some of them could not receive it probably because they are not in their address or for any reason. This is what is shown as unclaimed dividend. This belongs to those specific shareholders, not to anybody else. And this right does not get transferred when the share is getting sold. So we should not consider unclaimed dividend while calculating book value of equity. Now, having understood the broad principles on how to compute book value of equity, now let us see how do we compute another related metric called as book value per share. Book value per share is simply book value of total equity, which includes convertible preferred shares and convertible debt, which we expect to be converted. Take that book value of total equity and divide it by total diluted shares outstanding. How do we compute diluted shares outstanding? We already dealt with them when we were talking about diluted EPS, but here it's essentially going to be the total number of shares we have issued. From there, reduce any treasury shares that we are holding. Again, to reiterate, treasury share is the shares of the company that it owns by itself. So it's not held by any third party. So we reduce that. To that, we add up any dilutive components such as ESOPs, convertible bonds and convertible preferred shares. You add up to get the total diluted shares outstanding. So book value of total equity divided by the total diluted shares outstanding is what will give us book value per share. Having understood about book value, now let's understand about market value. Market value of an asset is simply the value of the asset at which it can be bought or sold in the market. But market price tends to change on a regular basis. On a trading day, if you look at the price, it's very fluid, it keeps changing. So when it comes to preparing reports or calculating any ratios based on market price, analysts typically use the close price of the previous trading day. When it comes to equities, we also need to understand about a term related to market price, which is called as market capitalization. We also call it as market cap. Market cap is simply the total number of shares outstanding multiplied by the market price. But here again, when it comes to total number of shares outstanding, we don't just take into consideration the basic shares, but we also take into consideration the dilutive shares. Dilution coming on account of employee stock options, convertible debt and convertible preferred shares. One thing about market value is that in order to compute that, the asset should be trading in a market. Only then we would know the market price. If an asset does not have an active market or it's not traded anywhere, we cannot get its market value. And a company's balance sheet has plenty of items which are not traded in any market. These include items such as bank debt, minority interest or non-controlling interest, unlisted equity shares, unlisted preferred shares or unlisted bonds, and your fixed assets. There are many such items for which market value cannot be computed. So what do we do if market value cannot be computed? In such case, we either take the book value as the proxy for market value, which could be okay for certain unlisted debt, but in certain other cases, we may have to use a model for fair value model as a proxy for market value. Now with that context, let's jump and talk about how fair value is computed. Or first, let's start with what is fair value. Fair value represents the price at which an asset could be exchanged or a liability can be settled between parties who are knowledgeable, who are willing to trade, and they're trading in an unrestricted and open market. One thing about fair value is that it's a theoretical construct. In the sense, we can compute that using mathematical models, but we cannot observe it in real life. In real life, we can observe market prices, but we cannot observe a fair value. So fair values have to be determined only using models. And these fair value models can broadly be classified into two categories. One is what we call as no arbitrage pricing. This essentially comes from the principle that you cannot have pricing discrepancy in the market. The other model we talk about is intrinsic valuation models, where we determine the value of a security using the present value of its future cash flows. No arbitrage pricing can be further classified into two categories. One is selling price based approach, another one is cost based approach. Intrinsic valuation can also be broken into two categories. One is the real world approach, another one is the risk neutral approach. Let's understand them in detail one by one. Now let us first understand the no arbitrage pricing principle. The no arbitrage pricing principle, as we discussed earlier, simply assumes that we cannot have pricing discrepancy in the market. And this forms the basis for valuation. And here we have the first approach, which is the selling price based approach. The idea is that two assets with same or similar cash flows should also trade at same or similar valuation. To understand this principle, let's take a look at two house properties. You might have looked at properties for buying or renting. So when there are two properties which are similar in nature, you would expect their prices to be similar in nature. But let us say one property is getting sold at $110 per square feet and another, a very similar property in a very similar location, highly comparable, is getting quoted at $200 per square feet. Now what's likely to happen? The buyers are likely to give a thumbs down to the expensive property here because very similar, so why would I pay such a huge premium? In that case, what is likely to happen is the premium property would see its price getting revised downwards because other comparable properties are getting sold at a much lower prices. So you will see this property getting sold also at a similar price levels. But if market price is so high or market demand is so high that there are takers for the $200 per square feet apartment or property as well, then what is likely to happen is the sellers who are selling the other properties at lower prices will revise their price upwards. So all the properties may see their prices getting revised to $200 per square feet. This is the fundamental idea behind selling price based approach. We will see a little later in terms of how these approaches are applied in valuation of equities, but that is in a different video. Now the other no arbitrage pricing approach is cost based approach. So here the principle is that the fair value of an asset should simply be equal to its cost of making plus a fair margin. At the end of the day, anybody who makes an asset would expect some margin. So for example here, let's say it's going to cost me $120 per square feet to build an asset. Then adding a certain margin here, I may want to sell it at $150 per square feet. That's a 25% margin we are talking about, which people may consider to be fair for something that takes a year or two to get constructed. But on the other hand, if we're going to quote $300 per square feet, that's probably is not a fair value for this. Now moving on to intrinsic valuation. Intrinsic valuation of a financial instrument is equal to the sum of present value of the expected future cash flows. But here again we have two approaches. One is the real world approach. In the real world approach, we discount the estimated cash flows of a financial instrument or future cash flows by a fair rate of return. A fair rate of return here includes a risk premium. So the cash flow is what we estimate to be most likely to come, and the discount rate includes the risk-free rate plus a risk premium because there are chances that we may not actually get the cash flows which we estimate to receive. So we take the present value of all such cash flows, sum it up, that gives us the fair value under the real world approach. Risk neutral approach on the other hand discounts the probability weighted cash flows by risk-free rate. So here the cash flows are adjusted downwards for the probability of realizing that cash flow and we discount it using the risk-free rate. Let's understand both these approaches with some simple example here. Let us say there is a AA-rated zero coupon bond. A zero coupon bond is something that gives money only at maturity. At beginning, you have to invest and you get the money back at maturity. In between, you do not get any coupon or interest. So let us say here is a AA-rated zero coupon bond, which will mature in 2 years' time. And at maturity, we will get $100 or rupees. Risk-free rate is 4%. And given the risk involved, let's say investors expect 2% risk premium. So how do we determine its fair value? So we expect to receive 100. Or rather we estimate that we would be receiving this 100. But there's a chance that there could be default and we may not get this money. So what we're going to do is we're going to take this 100 and we're going to discount it using a rate that includes the risk premium. So our discount rate is going to be 4% risk-free rate plus 2% credit risk premium. So total 6%. So we take 100 divided by 1 plus 6% raised to the power 2 because it matures in 2 years' time. Now let's also understand the risk neutral approach here. A very similar bond we are talking about, 100 at maturity we're going to receive in 2 years' time. But let's say here the analyst has determined that there are 3 possible scenarios. 1, there is no default, you will get your 100, and this has 80% chance of occurring. This is the analyst assessment, let's say. And there is some default and you could recover partially your investment, and let's say the partial recovery we expect to get 60, and let's say this has 15% chance of occurring. And there is 5% chance that you would lose your entire money. So this is a kind of situation where we apply the risk neutral approach. So here what we're going to do is, we'll take the cash flow, multiply it by the probability to arrive at the expected cash flows. So our expected cash flow here is 100 is the no default scenario cash flow. It has 80% chance of occurring. So 100 times 80% is 80. Similarly, we have 80 times 15%, which is 12, and 0 times 5%, which is 0. So when you sum it up, expected cash flow here is going to be 92. When we talk about expected cash flow, it essentially refers to the probability weighted average of all the various possible cash flows. Now, having got this expected cash flow, keep in mind we have already reduced the cash flows. We are not taking 100 as the value. We are only taking 92. So while discounting, we will not consider any risk premium. We will discount it at risk-free rate. So 92 upon 1 plus 4% raised to the power 2, which is 85.1. This is the core principle of valuation using the real world approach and risk neutral approach. Now, having understood all the principles of valuation, in the next part, we will go and see how these are applied in valuing equities or business of a company. Thank you.